Today we'll talk about estate planning after 2026 estate tax sunset, but we will cover more than just that. We will cover what will happen between now and then, and how to prepare yourself, and also how to anticipate changes will affect your estate, exclusions, overall tax brackets, and etc. So there's going to be a lot of information related to now versus 2026, and what we should anticipate happening if a sunset does indeed happen. So let me give you a little bit of background, and we'll talk about that a little bit more. So first of all, our focus today will be on how do we pass assets to the next generation and occur no tax or little tax. What's the right way to do it? How do we create a legacy? Very important topic. I cover it all the time in meetings. And it's very appealing to a lot of people, because we feel that estate planning decisions affect those who you love the most. And if you do them right, then those who come after you will pay less tax, they will be more informed, and also well off financially. So today we'll focus on how do we pass that generational wealth, and how is it different now versus in 2026. So if you remember, in 2017, we had a tax act that completely changed the landscape and estate planning. So that act, enacted as of December 2017, effective January 1st, 2018, basically moved estate tax exclusion from $6 million to 12 per person. And now, as of 2023, that amount is 12.92 per person. So if it's a family of two, you double that amount by 2. What does it mean? It means that if you stayed as at that level as a family, double $12 million, almost 13, so let's say $26 million, then you are not subject to estate tax. Estate tax is not income tax. It's a separate tax levied on estate upon second death. Second death means after your spouse passes away. If you're one-person household, after your death. And if your estate is over that amount, then you are subject to 40% estate tax on that difference. Example is, you're a single person, your estate is $15 million, and your current exclusion amount, if you pass away this year, is 13. So $2 million will be subject to estate tax, and federal tax will levy 40% tax on that amount. So you will have to, your estate, not you, will have to pay $700,000-$800,000 worth of tax to IRS. So that's how it works. Now, the exclusion amount at this level is very generous. We've never seen this before, and we know that if no congressional decisions will be made by December 31st by 2025, the sunset will happen. Means everything reverts back to prior to 2017 act. That means that your exclusion amount, if nothing happens, will go to $6.46 million. And I would like to go over what does it mean to you. How do you prepare yourself? So I would like to go into the next slide, because actually I want to go right in here first to show you something. So you can see here that exclusion amounts through the years were fairly low. And the reason I'm saying low, because in Bay Area, single family home ranges between $1.5 million to $2 million. So if you can see in prior years, the exclusion amount in 2017 was 5.49. So, and then it jumped, it doubled in 2018, and it stayed that way. And it was also increased by inflation to a very sizable amount. So you can see that it is very unlikely something will need to happen. And most likely it's going to be some sort of rules that governing coming forward next 10 years or next 5 years, all the exclusion amount. If exclusion goes back down to $6 million, that many more households will be subject to estate tax. It's very difficult to avoid estate taxes, and that's why planning for it many years before this generation is gone is extremely important. And I'll show you a few ways to do it. Now, one great benefit of the current law is if one of the spouse didn't have one spouse passed, let's say the estate value is $6 or $7 million, And so it's not the entire $12 million that you can use. Guess what? His or her estate will be excluded from estate taxes, and the difference between what was unused, which is $12 million minus 6, can be carried forward to a spouse. So now spouse will have $12 million if, God forbid, that person passes next year, plus unused exclusion amount, which is in this case will be a few additional $1 million. So that's called portability rule, where you can port unused exclusion amount toward your spouse. So great law really helps people to avoid estate taxes. Currently, only less than 1% of US population is subject to estate tax. So we'll talk about 3 scenarios, and I'll go back to show you other slides. But also remember that because inflation is so high, they increasing and upping these amounts by a much larger number than in previous years. So exclusion amount grows very quick. All right, so let's talk about different strategy and consideration. So I don't want to jump back and forth, but our first consideration I want you to be familiar with is that not only estate exclusion will be different, but also if we have a sunset going into 2026, means everything reverts back to the same law prior to that current law, then the federal income tax rate will change. And you can see here in the middle that married filing joint and a single income filer brackets. And you can see that the current tax law showing that if you are a single person, your taxes and you make less than $11,000, nothing changed for you. But everything above it, you will pay a little bit more tax. Let's focus on married filing jointly. Currently, if you make up to $90,000 taxable income, your current tax bracket is 12%. The old law, if it goes back to 2026 sunset, is actually 15%. And you can see pretty much across all tax brackets, the difference is higher. Means if we revert back to the old law, you'll be paying no tax. What does it tell us? It tells us that if there is any opportunity for you to either transfer appreciated asset to a family member, maybe a stock, through gifting, or you can shift around and pay some tax between now and 2026 gradually, it will be more advantageous than going back into the old bracket level because you'll be paying no tax. So that's very important part, and you need to prepare for it. Maybe you need to spread out some capital gain stock sale. Maybe you can spread out some gifting to your family members. So your estate and how much you report on the tax return will be less should the sunset happen. So tax bracket is important to watch. The second consideration is what we just talked about. It is our estate exclusion amount that potentially can go down by half. So how do we take advantage of what is out there right now? It really depends on your estate level. So the consideration number 3 is called evergreen gifting strategy. What those are is the gifting strategy that anybody can employ. They're very simple, and they over time reduces your estate, especially for those folks who has a $3 million or less total net worth. Let's talk about what net worth means. So net worth is all of your liquid assets, investments, savings, plus equity in your real estate, in your primary residence, rental properties. It could be also private holdings. Maybe you are a member of some tenants in common. Maybe you're a member of some real estate trust. So all of the equity of that is included in your net worth. So if your net worth total of $3 million or less, you're not immediately subject to all of these new rules changing or the sunset. It's not going to affect you as much. However, gifting will allow you to shift some of the estate now to your children or grandchildren without using your exclusion amount. If you make a $17,000 gift to any beneficiaries, it could be your children, between husband and wife, it's $35,000. And you can make it to each beneficiary. If you have 2 children, you can make $17,000 to one child, $17,000 to another. And your estate exclusion amount does not get reduced. So you don't need to worry about filing 709 form of gifting and everything. So $17,000 is right under the amount where you have to report. It's a great opportunity for you to look into appreciated assets and say, well, I really don't want to, I'm not going to use the money. Most likely I would like to give it to my children or grandchildren. And I don't want to sell it to pay capital gain tax. So you can gift appreciated asset, and your heir is either your child or grandchild can sell it and pay very little capital gain tax if their brackets are very low, or can hold on to it for a long time. So shifting a highly appreciated asset, it could be a stock, it could be gifting them just actual cash, or gifting a property to children, help you passing those highly appreciated assets to them earlier. Let's talk about the property. Usually, if it's your primary residence, passing that on to your children while alive is not a good idea, because your children will not get a step up on cost basis. So usually primary residence is ideal to be given to children at the time when the last family member passes. Another interesting consideration that a lot of people are interested is, how do we help children or grandkids go to college? So you as the parent or grandparent can upfront 529 plan contributions for 5 years. So $17,000 times 5, you can contribute $85,000 per beneficiary. So if you have 2 grandchildren, you can set up a 529 plan and put $85,000 times 2 into that plan. You are not allowed to make any more contributions toward that plan for the next 5 years, but you let that money grow. Like, for instance, the market is down right now, it's not doing that great. So if you put the contributions in and they grow and double in price in 10 years, then all of this growth is tax-free to the recipient, to the beneficiary, to your grandchild. Another great addition to the recent changes, Secure Act 2.0, that was enacted, we spoke about it last time I was here in January, allows grandparents to fully contribute to 529, and grandchildren or students eligibility to receive need-based financial aid is not affected. So even if you might have $100,000 529 from grandparents sitting alone for the grandchild to use, they still may be able to qualify as long as their family income, their parent rental income, is very low, or they have no other means to go to college. So great provision. Another one that's new and also came from Secure Act 2.0 is that you can roll some of the 529 funds, unused funds, after college is been finished, into a beneficiary Roth IRA. Amount total is $35,000 currently. Maybe they will change it, but now we can establish a Roth account for beneficiary and then roll that amount from the 529 where you're the owner into the child's Roth IRA and help them establish the Roth account. You know the benefits of Roth account, that grows tax-free and you can take the money anytime. Penalty-free principal after 5 years of establishing Roth account, and penalty in interest and appreciation free, obviously, when you retire, which much later, 59.5. Consideration number 5, pay for qualified tuition and medical expenses directly. What that means is, if we know that the maximum amount that you can give away without tapping into estate exclusion amount is $17,000 in 2023. So, and you would like to contribute more toward the child education, plus help the child with some medical expenses or tuition. So you can pay for tuition separately and also gift $17,000 on the top of it. So if you have a choice, making contributions cash to the child and child paid tuition versus you pay for tuition directly and you still have $17,000 unused, you can gift to your children or grandchildren. Same thing with medical expenses. If you're every year gifting your children $17,000, please do so and pay their medical expenses separately. Don't give them cash to pay for medical expenses. Pay it yourself directly. That is not counted towards $17,000 limit. Consideration number 6, maximize gifts to qualify charity. Very good topic to discuss. A lot of people are charitably inclined and to a certain degree. So let's talk about a different way of getting your tax deduction based on the contribution you're making. So if you're making a cash contribution, 60% of your AGI, that amount can be excluded from your taxes if you paid that toward charities. And it's a higher amount than it will be should sunset happen. Sunset limits that amount to 50%. Right now it's 60, so it's a higher deduction. So if there's any charitable causes you would like to contribute a large amount and you would like to deduct it at 60% of your AGI limit, please use this year's, the next year and 2025. We have 2 years left. If you want to contribute securities toward the charitable cause, then limitation is 30% of your AGI. But you don't have to worry about any capital gains. It goes right into the charities and you get a nice sizable deduction. Another one that a lot of people who are subject to RMDs should consider: once you reach age 70 and a half, you can send money directly from your rollover IRA toward the charity up to $100,000, and it will not be a taxable item on your tax return. So a lot of my folks, a lot of my clients who are subject to required minimum distribution, that they don't really need most of the money, and they're charitably inclined, what they do is we send every year money not from their bank account, not from their brokerage account, but directly from the IRA. And by doing so, the taxable required minimum distribution is reduced by the amount they contributed toward charities. It's called qualified charitable contribution, QCD we call it. You have to be of a certain age. You cannot do it sooner than 70 and a half. But it's a great way for you to reduce your taxes and also at the same time contribute toward charities. I don't know if you ever heard about Donor Advised Fund. It's a fairly new vehicle, but Donor Advised Fund, you can establish in pretty much any institution. We do it all the time here at LPL available. We can aggregate, let's say you want to establish a Donor Advised Fund, you make a large contribution, $50,000 into that fund, into that your own account, and that will give you a deduction, immediate deduction. And then every year, you just write a check from that account directly to different charities. So you don't have to make decisions what charity you need to send the money to. You can spend a number of years writing those checks. There might be a year where you received a large grant, or maybe you changed the job and your company was bought out. So you're looking for some sort of deduction. So making a larger contribution into a Donor Advised Fund, taking the larger deduction, and then later on giving money to different charities to deplete this account over time. And this account also will grow because it's invested. So not only you, let's say you give $100,000, now you might be able to give even more. And there is no tax ramifications of doing so. It's a great way for to make a contribution and also just simply write checks out of that account over the next number of years. And there is also a way to give through various charitable trusts. There is a charitable remainder trust, charitable annuity trust. So those trusts usually work this way. I'll describe charitable remainder trust, where you give a large amount to charity, and then that will be tax deductible to you. I have a client who is selling a business, a large amount of money coming to him through capital gains. So he established a charitable remainder trust, give the money to charity, get tax deduction, and then over the course of the years, that trust will spin out 5% interest to the client for the rest of his life. So another way to do it and reduce your taxes and also generate income stream. So a lot of ways to donate to charities and at the same time reduce your tax liability. So now let's talk about where it makes the most sense. So we broke down average estate into 3 different types. One that's around $3 million, a little bit over. So you don't have immediate estate situation. You don't have immediate estate tax liability. But however, look at the right side here. If you can see, if your account is $3 million or so, or your total net worth is $3 million or so, and you make 4% rate of return each year on that money, the money will, you can see here that in 17 years, your money will go over $6 million exclusion, which means at some point of time, you potentially might be subject to estate tax. If that's the case, so if your estate is between $4 million and $6 million, then you can do an evergreen strategies we just discussed, which are these. I'll show you. Evergreen strategies, which means you're making $17,000 contribution, either in cash or in securities, and you also can make a contribution toward the 529 plan of your beneficiaries. So evergreen strategy works great for those folks with estate between 3 and 6. So you're kind of keeping most money to yourself. You're not subject to estate taxes till many, many years from now, but you're actively employing the $17,000 exclusion amount each year to gift. So you're minimizing the growth of your estate over time, right? So this is a very important consideration because it does take many years for you to get out of estate. And if we don't do a proper planning, at some point of time, once you estate is $6 million, it would be very difficult to control the taxation on it. So you need to do your math. If your rate of return on your portfolio is 6 to 7%, then you probably will go over $6 million estate in 10 years or 12 years. So that becomes consideration. Now, let's talk about these people who are between $6 million, which is 2026 exclusion amount, right? So if no rules are changing, our exclusion amount on the estate goes to $6.46 million. So if your estate right now is right between $6 million and $12 million for single person, or between $12 million and 25 for married people, then you need to start actively seeking estate planning. You need to decide how much charitably, how many dollar amount can go toward charity if you're charitably inclined. Or you can decide, is 5299 plan is a good idea? Because if you establish a 5299 plan and make a contribution, that amount will be out of your estate. And if that amount is out of your estate, then whatever grows into 529, even if you overfunded it, will not be considered as part of your estate plan. So evergreen strategy, $17,000 a must for this estate purposes. Also actively participating in 529 contributions for your beneficiaries, and looking to see at what level you will exceed that $12.92 million for single person exclusion, and then see if you need to do any other strategies like trusts, or maybe not. So you have to balance between how much you personally need. People who have $12 million or so total net worth generally are doing well, and they already have enough income stream, so they can afford and start gifting. Assets over $12 million today for single person, or 25, almost 26 for joint, for married couple. Tax planning strategies are must. Why they must? Currently, you can allocate funds. It doesn't have to be specifically your children. You can allocate it in an irrevocable trust. And if you allocate $12 million or so in irrevocable trust, guess what? The IRS doesn't have a clawback saying, well, guess what? 2026, if state tax exclusion went down to $6 million, now you have to revert back that gifting. No, they say, we will honor it. It's a law. They say, we'll honor it. We have to get updates to make sure that there is nothing changed. So before you do it, you need to talk to your CPA, your estate attorney. But once you confirm it and you make a large contribution, that amount is out of your estate. So even if the sunset happens and the state tax exclusion goes down to $6 million, you already put away enough money that will take advantage of that higher amount. So let me go back to this slide here. I want to emphasize something. $12 million is not just the exclusion from your estate. This is when the person passes. It's also the amount of gift that is excluded from tapping into your exclusion amount. Means you can gift so much, and gift amount and exclusion amount currently at the same level. They've always been the same level. So gifting so much toward your irrevocable trust, toward your other charitable trusts, it will allow you to be under the exclusion amount on such a higher level. So it's extremely important for those families who are at much higher estate level. I hope if you're the one, you're talking to your estate attorney, your CPA, talk to your financial advisor. We're also happy to discuss that with you and devise a strategy. We do it all the time. We see those situations where people don't start it on time. This should have been started at 2018, and over time the strategy should have been, developed. But if you're the one that haven't started it, I would suggest have a conversation with your financial advisor, with your CPA and an estate attorney to figure out as the team what would be the best approach for you to keep the assets and have control over it, but at the same and income, but at the same time utilize such a higher exclusion amount, because it is very likely if you don't use it, it will be gone in 2 years. All right. My recommendation in general, if you interested to learn more about estate plan, pull your estate documents. Take a look what's written there. How old is the document? Generally, if the estate document has not been updated in the last 10 years, it needs an update. The HIPAA rules have changed. There's few provisions have changed. You can see this estate exclusion has changed. So it's time to evaluate it to make sure that it is up to date, because avoiding estate taxes is literally almost impossible if you're doing it in the last minute. So tax planning, it becomes critically important. This sunset law, the old law that will come in should the sunset happen, affects not only estate tax, not only gift tax, not only income tax brackets, but it affects also, because everything will go back to, you can now have personal exclusion amounts again, right? Your SALT limitations will be lifted. So there is a lot of considerations besides just estate. But estate is probably the largest opportunity here for those whose estate, I would say at least $5 million, you need to start doing some planning. And you need to see which family member needs to help the most, how to make it equal. So there is few considerations. The way you structure the estate document, that is fair to every family member, everybody is happy with that, as you can see it. And then how do we avoid estate or minimize estate taxes if possible without losing too much control, which is very difficult to do. Once you put your assets into irrevocable trust, you really don't have control over your assets, but that's the only way to get your assets out of your estate to grow tax-free outside of your estate. So you can decide, how much would be, enough for me to put it in to make a dent and reduce my estate taxes without losing control over the funds and have enough funds for yourself in later life. But you really need to decide, either you write a check to IRS or you write a check to kids. You can see who you like the most, So that was our general topic today. I would be happy to take some questions to see how we can, have a conversation about it. This topic is very, very big and broad. So I'll be happy to see if we can talk about, specifics. So Lisa, would you like me to read it, or how would you like to do it?
Hi, Larissa. Thank you very much. There's one question in the chat box, and if anybody else has another question, please feel free to enter your questions or unmute yourself and ask the question directly to Larissa. There's a rather complicated question from Jeff. It's pretty long. I don't know if you can see it in the chat box.
I see.
So it's basically a scenario where there are different assets and different shares of the assets amongst
I
the
see
two spouses.
If spouse A owns 1/3. So
Right.
Let me just give you a background. So I'm a certified financial planner. So my job is to oversee the entire person's financial situation, from taxation, investment plan, retirement planning, estate planning. And so I specialize in all of these areas to give you a very solid background to see where the problem might be. And if we need anything very specific to estate plan, the estate attorney and I work together to devise the plan. So I'm not an attorney to drop you an estate document, just so you know my limitations. So if spouse A owns 1/3 undivided interest in a rental house, and as his sole separate property, as a tenant in common on title, and grants title to the spouse A, to grant spouse A, and spouse B revocable trust. Wait a minute. On title and grants title to the spouse A and spouse B revocable trust on a trust transfer deed. Okay. However, when spouse A is no longer on earth, would the revocable trust outright to the beneficiary along with the pour-over will along with the able? So let's talk about tenants in common situation, right? Because generally, a tenants in common, if you own a property as a tenant in common, your portion does not go to the other person immediately. It usually goes to the A person who passed away first to their heirs. So that's the beauty of tenants in common. I rarely see that spouses A and B own a tenants in common unless it's a second marriage. Second marriage will say, hey, you know what? We're going to buy a property together. We're 50 years old and we're going to live in it till we die. And I want my kids to inherit half of it and his kids to inherit half of it. So in this case, and it's a tenant in common title, in this case, when the first person passes, his portion or her portion will go to his kids, where he allocated to her kids. So tenants in common is not a right, the right or maybe ideal title if you want to use pour-over will, and if you want to, now you're talking about capital gain tax. So capital gain tax is not applicable if it's a right of survivorship title. If it's a tenant in commons, completely different because the ownership is different. There is no step up. So we need, it's a great question. I need to look into that a little bit more to make sure what you're trying to achieve. But the best thing to do is to start with what you're trying to do. What do you want to do? How do you want this to be passed? Do you want estate taxes? Do you want to avoid, capital gain tax? Do you want this asset to go to someone else? Once we have all of these figured out, we can then walk backwards and to say, oh, this is what kind of title you need. Because right now, if you want to avoid capital gain tax, then you probably need to either set up an, I don't know, maybe LLC, or you need to consider title with right of survivorship. The only way to avoid capital gain tax, if both spouses, let's say it's a second marriage, is your portion, when first person pass, goes to your heirs, and your heirs will consider it as their primary residence, and they will hold it till the other person passes. So generally, if you want this asset to go to same beneficiaries between spouse A and spouse B, then you don't want to hold title tenants in common. You want to hold the title either in your trust that gets a full step up in basis after first death, or you want to hold the title as the community property with a right of survivorship. In California, it allows you a step up in basis. So I might not be answering your question completely or exactly how you want to know the answers, but I'm happy to take a look at it. Separately, I probably can copy some of the information here and respond to you via email if you provide your email address to me. Let me.
Or can they email you?
Yeah,
Larissa?
they can email me directly. This is my, if people can see my email address, okay, they can email me directly and also tell me what's your goal for the for this titling, because sometimes people title all kinds of ways. They just title because that's what was suggested or what they thought it the best. But if you want to tell me what you're trying to avoid and how you want this asset to pass, then I can walk you to the point what kind of title you should consider. And if I don't have the answer, I can definitely find an answer for you.